feel like navigating your finances, especially taxes? It's like trying to solve a puzzle, but you're missing half the pieces.
Oh, definitely.
It's just so easy to feel overwhelmed, right? Wondering if you're missing something big or, maybe worse, making a mistake that costs you.
You're absolutely not alone there. I mean, the world of income tax management, it can feel incredibly dense, almost like it's designed to be confusing.
Exactly. And that's really why we're doing this deep dive. Think of it as your shortcut. We've looked at your sources, all that research, those articles, your notes, and we're going to, boil them down into clear, actionable stuff.
Right. We're kind of your guides here, cutting through the noise, helping you focus on what actually matters.
Our mission today is to unpack the really crucial concepts in tax management, maybe reveal a few surprising facts, and just help you navigate this whole landscape more strategically.
And we'll show you how tax strategy fits into your bigger financial picture. Because, as we'll get into, just minimizing tax, that's not really the ultimate goal, is it?
Good point. Let's kick things off with a pretty fundamental idea, one that might challenge what a lot of people assume, that minimizing your tax bill is, goal number one.
Ah, yes, the classic tail wagging the dog scenario.
Exactly. Our sources suggest that focusing only on minimizing taxes without thinking about your other goals can actually backfire.
It really can. I mean, taxes are obviously important, a big factor, but if that's your only focus, you might compromise your overall wealth building and, more importantly, maybe your family's well-being down the road.
So tax strategy is crucial, but it's a tool.
It's an aid, yeah. An aid to help you reach your bigger financial objectives. It's not the objective itself.
Right. So it's about being smart, strategically efficient, not just obsessed with the lowest tax number. Okay, so to help us picture this, the sources bring up a really useful concept, the tax triangle.
Yeah, the tax triangle. It's often used by folks in the industry. Think of it like a visual aid, really. Helps people grasp how the tax system works for different kinds of investments.
A visual aid.
Uh-huh.
Okay.
But, and this is key, it's not a planning tool in itself. It doesn't mean there's one best way or that you should put, a third in each category.
Oh, okay.
Diversifying across these tax treatments, it's more like a hedge. A hedge against future tax laws changing. Because, let's face it, predicting future tax law perfectly, that's kind of a myth.
That's a really important point for people listening. So it's about managing risk, not finding a magic bullet. Okay, let's break down the three sides of this triangle. First up, after-tax money in. These are non-qualified accounts, right? NQ.
Exactly. NQ accounts. You buy these investments with money you've already paid income tax on. Kind of like buying groceries, the tax is already handled.
Got it.
Now, if the assets inside, like stocks or real estate, go up in value, that growth is usually tax deferred until you sell. But, and this is a big but, any earnings you get along the way, dividends, interest that's taxed each year. And here's something tricky. Even deemed earnings from things like mutual fund trades inside the fund, what we call phantom tax, that gets taxed annually too, even if the fund's share price didn't go up or even went down.
Phantom tax. Wow, that sounds like it could be a nasty surprise. We should definitely dig into that more. But first, category 2, pre-tax money in. Quantified accounts.
Right. This is your traditional IRA, your 401k, 403b at work. You fund these with money before it's taxed, or you get a tax deduction for contributing.
Okay.
So your contributions, the earnings, any employer match, it all grows tax deferred. The catch.
The catch is you pay tax later.
Exactly. All withdrawals in retirement are taxed as ordinary income. And another crucial thing, RMDs, required minimum distributions. After age 70 and a half, you have to start taking money out.
And if you don't take enough?
Big penalty, a 50% penalty on the amount you should have withdrawn.
Yeah.
Ouch.
Ouch indeed. Okay, then the third category, this is the one that often sounds almost too good. After-tax money in, tax-free income out.
This one really is powerful. Here, like the first category, your contributions are after tax. But the big difference is the growth and the qualified withdrawals later on are generally tax-free.
Okay, examples.
Roth IRAs are the classic example, especially good if you think you'll be in a 15% or higher tax bracket in retirement. Then you've got covered education accounts, health savings accounts, HSAs, which are amazing tax shelters way before retirement.
HSAs are fantastic.
They really are. And certain types of life insurance policies, if they're structured right, can also fit here, giving you tax-free income.
Okay, so just to make sure everyone's clear, people sometimes get confused between the account type like IRA, 401k, Roth, and what's inside it, like a mutual fund or a stock. Can you clarify that difference?
Oh, that's a super common point of confusion. Think of the account designation IRA, 401k, brokerage account as the tax wrapper. It dictates the tax rules for the money inside.
Right.
The things you hold inside that wrapper, mutual funds, stocks, bonds, annuities, those are just the investment vehicles. You can hold a mutual fund in a taxable brokerage account, or in a tax-deferred IRA, or in a tax-free Roth. It's the wrapper, the account type, that determines the tax treatment.
Got it. The wrapper dictates the rules. Okay, let's circle back to that phantom tax you mentioned for those non-qualified taxable accounts.
Right.
You might think, hey, I didn't sell anything, so no tax.
Yeah.
But that's not always how it works with mutual funds, is it?
Not at all. It catches so many people off guard.
Yeah.
See, the manager of the mutual fund, they're buying and selling stocks or bonds inside the fund all the time trying to meet their goals.
Okay.
When they sell something for a profit within the fund, those capital gains have to be distributed to the shareholders. That's you.
Even if I didn't sell my shares of the fund itself.
Exactly. So you get a 1099 tax form reporting income, these capital gains distributions, that you were deemed to have received, even if your fund's share price actually went down that year. It's phantom because you never actually saw that cash hit your bank account.
Wow. That has got to be incredibly frustrating, especially if you have plans for that money, like saving for a down payment or something.
It really is.
So for listeners who have these non-qualified accounts, maybe they're saving for a second home or starting a business, what can they do? What are some strategies to grow that money more tax efficiently and fight this phantom tax?
Okay, good question. There are definitely ways. First, you could look at blue chip dividend-focused funds. They tend to have lower turnover, meaning fewer of those surprise capital gains distributions. Plus, their qualified dividends get taxed at lower rates than regular income.
Lower turnover, better tax rates. Makes sense.
Second, owning individual stocks you pick for long-term growth. You control when you sell, so you control when you realize the gains.
More control. Okay.
Third, tax-controlled ETFs.
Yeah.
Exchange-traded funds. Many are designed specifically for low turnover and usually have low fees too.
Yeah.
Look for names like long-term equity or tax saver.
Tax-controlled ETFs. Got it.
And finally, something called unit investment trusts or UITs. These can be great because they often have no ongoing management fees. And here's the kicker. No turnover once the portfolio is set at the beginning.
No turnover at all.
Right. It's a fixed portfolio for a set period. That means incredible tax predictability. No phantom taxes from active trading inside the fund.
Those sound like really solid options to minimize that invisible tax drag.
What about a practical tip for managing these accounts as you get closer to needing the money, say for that big purchase?
Yeah, good point. Instead of selling your stock funds to reduce risk as the date gets closer, which triggers capital gains tax, consider using any new money you're adding to the account to buy less volatile things like bonds.
So you use new money for the safer stuff. Exactly. It helps you dial down the risk without having to sell your appreciated equities and pay the tax right away. So yeah, understanding phantom tax is really vital if you've got money earmarked for something specific in a taxable account.
Absolutely. Okay, let's shift gears a bit. Let's talk about a strategy that gets a lot of buzz. The Roth conversion.
Ah, yes, the conversion.
So just to define it simply, you take money from a traditional pre-tax IRA or maybe a 401k, you pay the income tax on it now, and then it goes into a Roth account where hopefully it grows and comes out tax-free forever. Sounds pretty sweet.
It does sound amazing, tax-free income later, but I often call it strategic heartburn.
Strategic heartburn. Why?
Because you're making a big trade-off. You're accepting a certain definite tax hit right now.
You pay the tax today.
Right. A certain loss up front in exchange for an uncertain future gain the tax savings down the road. And sure, maybe you avoid an early withdrawal penalty if you're under 59.5, but that's not much help if the market tanks right after you convert, or if your tax situation in the future isn't what you thought it would be.
Okay, so it's not a slam dunk. For a Roth conversion to actually make sense, what are the absolute must-haves? What needs to line up for someone to seriously consider it?
You really need three things to be true, and you need to be pretty confident about them. First, you genuinely expect to be in a substantially higher tax bracket during retirement. And I mean federal, state, local, the whole picture. Think maybe above 15% realistically.
Okay, substantially higher bracket later. What else?
Second, you need to anticipate significant investment gains inside that Roth account over time, gains that you'll then get to take out tax-free. If it doesn't grow much, the conversion didn't achieve much.
Right. Need the growth to make the upfront tax worth it. And third,
you need a long time horizon. You expect to be around for many years to let the investment growth work its magic and, frankly, to recover if there are losses early on after you convert. If any one of those three pieces is shaky, don't convert.
Okay, that's really clear. Higher bracket later, significant growth expected, long time horizon. If those do seem likely, when's the best time to pull the trigger? Is it like a perfect crystal ball moment?
Well, no crystal ball, but the ideal scenario is usually when two things happen at once. One, you're in a temporarily low-income tax bracket year. Maybe you got laid off, you're switching careers, starting a business that has losses initially.
So a dip in your income.
Exactly. And two, ideally the market has taken a hit, it's down, but you expect it to rebound. Converting when assets are cheaper means you convert more shares for the same tax cost.
Convert low. Makes sense. Any other tips on timing?
Crucial tip. Pay the conversion tax from outside funds. Use cash you have saved elsewhere, not the money you're actually converting.
Why is that so important?
Because if you pay the tax from the conversion money, you're immediately reducing the principal that goes into the Roth. You want the full amount working for you, growing tax-free. So pay the tax from a separate pot of money.
Preserve the principal in the Roth. Got it. But what about those hidden risks? Things that maybe don't show up in a simple spreadsheet calculation when you're planning this.
Yeah, the spreadsheets often miss the real-world curveballs. For instance, what if future tax rates actually go down or stay low? A lot of the projected benefit of converting evaporates.
Right. Future tax rates are guess.
Totally. Second, maybe your income in retirement isn't as high as you projected. Maybe your career didn't go as planned, or you face a disability. You might not end up in that high bracket you anticipated.
Okay, life happens.
And third, investment losses, especially losses early on after converting. They have a much bigger negative impact than losses later. Remember, the upfront tax hit is 100% certain. The future investment gains and tax savings, not guaranteed.
So if converting feels too risky, or those conditions just aren't right, what's a better alternative for someone who still wants to build up some tax-free income for retirement?
If the conversion math doesn't look great, or it just feels too uncertain, I strongly recommend building your tax-free savings using new money. Contribute regularly to a Roth IRA if you're eligible.
Start fresh with new savings.
Exactly. Or consider that life insurance strategy we'll talk more about. Using new money avoids that definite upfront tax hit on your existing savings and sidesteps some of that timing risk. Now, the current Roth IRA limit is $7,000 plus another grand if you're 50 plus, so it takes time to build a large balance that way, but it's a much less risky path than converting a large traditional account under uncertain conditions.
Okay, building it slow and steady with new contributions.
Yeah.
You mentioned life insurance again there as a kind of Roth emulator. That sounds intriguing. How can life insurance help someone save beyond those Roth IRA limits?
Yeah, it's a strategy that can be really powerful, especially if you already need life insurance coverage anyway, and you've already maxed out your Roth IRA contributions.
Okay, so who is this for?
People who need insurance and want more tax-advantaged savings. The basic idea is you overfund certain types of permanent life insurance policies.
Overfund, meaning you pay more than the minimum premium.
Exactly. You contribute more than required to keep the death benefit in force, but you have to stay within specific IRS rules, the MEC guidelines, modified endowment contract rules. If you put too much in too fast, it becomes the MEC and loses some key tax benefits. The goal is to build up a substantial cash value inside the policy.
Okay, build cash value within the rules. And then?
And then, later in life, you can access that cash value as tax-free income.
Interesting. What kind of policies work best for this? And what should you watch out for?
You want policies with really low internal costs, low mortality charges, low upfront loads or commissions, maybe 4 or 5% typically.
Right.
Critically, do not use a single premium life policy for this. Those are automatically MECs.
Avoid single premium.
Mm-hmm.
Got it.
If you look at variable life where the cash value is invested in sub-accounts like mutual funds, stick with major reputable insurance carriers to keep fees reasonable and always get a no-lapse guarantee rider. That protects your policy from collapsing if the market tanks.
No lapse guarantee. Important.
But personally, I often lean towards Equity Indexed Universal Life, or EIUL.
Equity Indexed UL. Why those?
Because they offer market-linked growth, usually tied to an index like the S&P 500, but they guarantee no losses due to market corrections. Your cash value might get zero interest in a down year, but it won't go backward because of the market. That guaranteed no market loss feature is huge.
Wow, market upside potential with downside protection.
Yeah.
Sounds appealing. How does the tax part work when you want to get money out?
It's pretty slick. First, the cash value grows tax-deferred, just like a 401k. Then, when you want income, you can withdraw your own contributions, your basis, completely tax-free.
Okay, basis comes out tax-free. What about getting more than you put in?
For amounts beyond your basis, you use policy loans, but specifically wash loans. The insurance company charges you interest on the loan, but they simultaneously credit your policy's cash value with interest, often at the same rate. The net cost is zero or very close to it.
So you borrow against it, but the interest washes out.
Exactly. And these loans are typically income tax forgiven if the policy is still in force when you pass away. The death benefit pays off the loan. The IRS does keep an eye on things for about the first 8 years to make sure it's not just an investment scheme, but after that, it's generally very efficient.
You mentioned a case study comparing this EIUL approach to a 401k. What did that show?
Yeah, an industry group ran a comparison. They took a 45-year-old non-smoker, assumed the same S&P 500 index performance over 20 years for both an EIUL policy and a 401k. The results were pretty compelling.
What did they find?
The EIUL policy generated about $58,500 in non-taxable annual income for retirement. The 401k generated about $49,400, but that was taxable income.
So more income, and it was tax-free from the policy.
Right. And on top of that, the policy had a higher projected death benefit remaining at retirement, over $960,000 versus about $760,000 for the 401k. That difference really comes down to the no-loss guarantee protecting the cash value in down markets and the tax-free nature of the income distributions, even though the policy was funded with after-tax dollars initially.
That's quite a difference.
Yeah.
So bottom line, if you need life insurance, you've maxed your Roth, and want more tax-advantaged growth, this is a serious strategy to look at.
Absolutely. A powerful tool beyond the standard retirement accounts.
Okay, let's zoom back out a bit. We've covered the tax triangle categories. What about taxing other income and assets? Municipal bonds, munis, are often touted as tax-free. What's the real story there?
Munis. Yeah, the big attraction is the tax-free interest. It's exempt from federal income tax. And if you buy bonds issued by your own state or city, the interest is usually free from state and local taxes too.
Okay, tax-free interest. Any other perks?
For retirees, that interest generally doesn't count as earned income when calculating if your Social Security benefits become taxable. So that can be helpful.
But there's a common misconception, isn't there? That they're super safe, risk-free investments.
Huge misconception. And potentially dangerous. Munis carry risks. There's default risk, the chance the issuer can't pay you back. This is generally higher for revenue bonds, which are backed by income from a specific project, like an airport or toll road.
Compared to
General obligation, or GO bonds, which are backed by the issuer's general taxing power. GOs are usually safer, but not risk-free. Then there's interest rate risk. If rates go up, the value of your existing lower rate bond goes down. And I also talk about political risk, a city relying on growth that suddenly stops growing.
Okay, so not risk-free.
Yeah.
And what's the hidden tax trap with munis? You mentioned your client, George.
George, yes. Here's the critical thing people miss. While the interest is tax-free, if you sell a municipal bond for more than you paid for it, that capital gain is taxable.
The gain on sale is taxed.
Yes. George found this out the hard way. He owned some Patrick Henry Airport revenue bonds. After 9/11, air travel plummeted, the bonds tanked. But around the same time, he got audited by the IRS because he had sold a different muni bond previously at a profit and hadn't reported the gain properly. He thought everything about munis was tax-free. It wasn't.
Wow. That's a tough lesson. So where do munis make sense for the average person, considering the risks and that tax catch?
For someone in a high tax bracket, tax-free money market funds are often a great place for your abrupt strays. Tier 1 cash reserves your emergency fund, short-term savings. They hold very short-term munis, so the interest rate risk and default risk are very low, and the interest is tax-free. Good combination of safety, liquidity, and tax efficiency for cash.
Okay, tax-free money markets for high brackets. Good tip. Let's switch to capital gains and dividends from stocks. They often get favorable treatment, right?
They often do compared to ordinary income like your salary. The key is understanding the difference between qualified and non-qualified dividends.
Okay, what's the difference?
Qualified dividends usually come from a company paying out its profits. These are taxed at the lower long-term capital gains rates 0%, 15%, or 20%, depending on your overall income level, your AGI.
AGI, adjusted gross income.
Right. And if you reinvest those qualified dividends, that's smart. It increases your cost basis in the stock, but you don't pay tax on the dividend when it's reinvested. Non-qualified dividends, on the other hand, might come from interest earned within a fund or certain other sources. Those are taxed at your higher ordinary income tax rate.
So qualified is better tax-wise. What about capital gains themselves from selling assets like stocks? There's a time element, isn't there?
Absolutely. It depends on how long you held the asset. Short-term capital gains are profits from selling assets you held for 1 year or less, taxed like ordinary income.
High rate.
Usually, yeah. Long-term capital gains are from assets held for more than 1 year. Those get the favorable 0%, 15%, or 20% rates. Big difference.
Definitely encourages holding investments longer. What if you have losses?
Capital losses can offset capital gains, which is helpful. If your losses exceed your gains in a year, you can deduct up to $3,000 of those net losses against your ordinary income.
Just $3,000 against ordinary income.
Per year, yeah. Any remaining loss beyond that $3,000 gets carried forward to future years to offset future gains or deduct later.
Okay, good to know about the loss rules. Now, a huge one for homeowners. The primary residence sale exclusion. Tell us about that.
This is one of the best tax breaks out there for many people. If you sell your main home, you can exclude a significant chunk of the profit from your income tax.
How much?
Up to $250,000 of gain if you're single or married filing separately, and up to $500,000 of gain if you're married filing jointly. That's huge.
$500,000 tax-free.
Yeah.
What are the requirements?
You generally need to have owned the home and lived in it as your main residence for at least 2 out of the 5 years leading up to the sale. The 2 years don't have to be continuous. Also, you can't have acquired the home through a 1031 like-kind exchange within the last 5 years. We'll touch on those exchanges later. And you generally can't have used this exclusion for another home sale within the last 2 years.
2 out of 5 years, ownership and use. That's the main one.
Okay.
And for landowners, you mentioned something less common, but potentially very valuable.
Yeah.
Agricultural use zoning.
Oh, yeah. This is a hidden gem for people with acreage. If you have land zoned for agriculture, even if it's mostly unused but generates just a little bit of income, maybe you rent it to a farmer or manage it for timber, you can often apply for agricultural use valuation for property taxes.
What does that do?
It results in extremely low real estate tax assessments. Can save you a ton on property taxes each year compared to its market value assessment.
Sounds great. Is there a catch?
There's a catch called deferred taxation, or sometimes rollback taxes. If you later sell the property and it gets rezoned for a more intensive use, like residential or commercial development, the seller usually has to pay back some or all of the property tax savings from the past few years at closing.
Oh, so you pay the difference later if the use changes.
Exactly. It's a deferral, not total elimination, but it's a powerful cash flow benefit for many years if you hold the land.
Definitely something for landowners to look into. These specific rules, munis, cap gains, home sales, ag use, they can really make a big difference in your actual wealth.
They absolutely can. Often overlooked.
Okay, let's talk about life's curveballs.
Yeah.
Sometimes you just need money, maybe even from your retirement accounts, before you actually retire. It's really important here, isn't it, to separate the income tax you'll owe from any potential penalty for taking it out early.
That is the critical first step. They're two different things. Money coming out of traditional pre-tax accounts, almost always taxable income. The penalty, usually 10% if you're under 59.5, is separate, and there are ways to avoid it sometimes.
Okay. What about loans? Can you borrow from retirement accounts?
Depends on the account type. First, super simple. IRAs, no loans allowed, period.
No loans from IRAs.
Okay. What about workplace plans like 401ks or 457s?
Those often do allow loans, but with very specific rules. You can usually borrow up to 50% of your vested balance, but no more than $50,000.
50% or 50K, whichever is less.
Right. And you typically have to pay it back within 5 years with interest, although the repayment term can sometimes be longer if the loan is for buying a primary residence.
Okay, but what's the big danger with these loans?
The huge danger comes if you leave your job, whether you quit or get laid off, while the loan is still outstanding. If you can't pay it back very quickly, usually within 60 or 90 days, the outstanding loan balance is treated as a taxable distribution.
And if you're under 59.5, boom, you also get hit with that 10% early withdrawal penalty on top of the income tax. It can be a brutal double whammy.
That sounds like exactly the trap your client Bob fell into.
Oh, Bob's story is such a cautionary tale. It really hammers home why you need competent advice.
Yeah.
He took a 401k loan, then lost his job. He went to an accountant, notice I didn't say CPA, someone who wasn't really qualified.
Okay.
This person wrongly told Bob, oh, just roll the remaining 401k money into an IRA, and we can just call the unpaid loan a hardship withdrawal later. Completely wrong.
What happened?
The loan became a taxable distribution plus the penalty. Bob got slammed with the massive, unexpected tax bill from the IRS. It was a mess, all because of bad advice from someone who didn't understand the rules. You need a fiduciary, someone qualified like a CPA or a knowledgeable financial planner.
Wow. Okay, so loans are risky if your job situation changes. But what about actual hardship withdrawals? Are there situations where you can take money out early and at least avoid the 10% penalty, even if you still owe the income tax?
Yes, absolutely. There are specific penalty exceptions allowed by the IRS. Some apply universally to both IRAs and qualified plans.
Like what?
Death and permanent disability. If the withdrawal is due to either of those, the 10% penalty is waived.
Okay, death and disability are universal waivers. Are there others specific to certain account types?
Yes. For IRAs only, the penalty is waived for withdrawals used to pay higher education expenses, tuition, fees, books, as long as they're paid pretty quickly, within about 30 days of the withdrawal. Also, for first-time home buyers, you can take out up to $10,000 penalty-free from an IRA.
Okay, education and first home for IRAs. What about 401ks, 403bs, 457s?
For those qualified plans and 457s only, there are different exceptions. One big one is if you separate from service, leave your job in or after the year you turn 55. Or age 50 for certain public safety employees like police and firefighters.
The rule of 55 or 50.
Exactly. Also, penalty waivers for unreimbursed medical expenses that exceed a certain percentage of your adjusted gross income. It's usually 7.5% or 10%. The threshold changes sometimes. And finally, for certain reservists or National Guard members called to active duty by federal order.
Okay, so there are quite a few specific situations. Knowing these rules could save you that 10% hit if life throws you a curveball and you absolutely need the funds.
It really can. It protects your savings from unnecessary penalties during tough times.
All right, let's transition into some more specialized strategies, maybe even peek at future trends. What about the individual 401k, the IndyK? Who's that for?
The IndyK or solo 401k is a great tool for self-employed people, small business owners with no employees other than maybe a spouse. It allows much higher contribution limits than SEP or simple IRAs, and you get that 401k loan feature, which IRAs don't have. So easier cash access if needed.
Sounds good. Downsides.
Well, they can have higher administrative costs, maybe $1,500 a year plus setup fees, maybe $300 per employee if you do eventually add staff. And the IRS does scrutinize them for compliance, so you need to run it properly to avoid audit issues. But very powerful for the right person.
Okay. What about something even more complex? Using IRA money to buy or start a business.
Ooh, that's wading into very tricky territory. High audit risk. It's possible, but heavily restricted.
House.
Generally, the business has to be structured as a C corporation or maybe an LLC taxed as one. No S-corp, partnerships, or sole proprietorships. And there are strict prohibited transaction rules. You can't have lineal relatives, parents, kids, spouse involved as investors. You can't hold a controlling interest, usually defined as more than 50% of the voting stock.
Lots of rules.
And the trustee costs for these self-directed IRAs that hold alternative assets like a private business are usually quite high because of all the due diligence and reporting they have to do. It's really an advanced strategy needing top-notch expert advice.
Definitely not a DIY project. Oh. Okay, another specialized thing you mentioned was net unrealized appreciation, or NUA, on employer stock in a 401k. Can you unpack that?
NUA, yeah, it's a pretty unique tax break specifically for company stock held inside your company's retirement plan.
How does it work?
When you have a triggering event, like you leave the company after age 55, you retire, you become disabled, or you pass away, or the plan terminates, you have an option, instead of rolling the entire account value over, you can take the employer stock shares out of the plan in kind.
Take the shares directly.
Yes. When you do that, you pay ordinary income tax only on the original cost basis of that stock, what the company paid for it when it went into your account.
Just on the cost basis.
Right. The difference between that cost basis and the stock's current market value, that's the net unrealized appreciation, the NUA. That NUA portion isn't taxed immediately. It gets taxed later when you eventually sell the shares. And importantly, it gets taxed at the lower long-term capital gains rates.
Ah, so you convert potential ordinary income into lower taxed capital gains.
Exactly. It's designed to encourage employees to hold company stock and participate in the company's growth. It can be a huge tax saver if you have highly appreciated employer stock.
Very interesting. Okay, what about REITs? Real estate investment trusts. You mentioned they have a tax advantage.
They do. REITs are companies that own or finance income-producing real estate. The special rule is that if a REIT distributes at least 90% of its taxable income to shareholders as dividends, the REIT itself doesn't pay corporate income tax on that income.
So it avoids double taxation.
Correct. That income flows through more directly to you, the investor, potentially leading to higher net returns compared to investing in a regular corporation that pays corporate tax before distributing dividends. Plus, many property-focused REITs are structured to allow for 1031 exchanges, deferring gains when they sell and reinvest in properties.
How do limited partnerships or general partnerships compare?
Partnerships also offer pass-through taxation, no corporate-level tax. But they often invest in more specific activities, maybe oil and gas, equipment leasing, medical research that generate unique tax benefits like depletion allowances or special deductions and credits. These pass through directly to the partners.
So potentially more targeted tax benefits.
Yes, but generally they come with higher risk than a diversified REIT, as you're often tied to a more specific project or industry.
Got it. Let's do a quick round on a few others. 1031 exchanges.
Right, we mentioned those. Allows you to sell an investment property and defer the capital gains tax if you reinvest the proceeds into a like-kind property within strict time limits. Using a qualified intermediary like Asset Preservation, Inc., which the source mentioned, is crucial to meet the IRS rules. Powerful tool for real estate investors.
Senior property tax discounts.
Very common at the local level. Many towns or counties offer property tax reductions for seniors, usually based on age, like 65 plus, and having income below a certain threshold. Worth checking your local municipality's rules.
Non-qualified deferred compensation, NQDC.
NQDC, often called golden handcuffs. These are plans employers offer to key executives to let them defer compensation and the taxes on it above and beyond what regular 401k limits allow. The deferred money isn't taxed until it's paid out, usually years later.
What's the risk?
The main risk is employer credit risk. Since the money isn't formally set aside in a trust like a 401k, if the company goes bankrupt, the executive might be just another unsecured creditor. That's why life insurance is often used as the funding vehicle by the company. It provides a more secure source for the future payout.
Financial planning fees, are they deductible?
The portion of your financial planning fee that's attributable to asset management or investment advice is generally tax deductible as a miscellaneous itemized deduction, subject to certain AGI limits. The part for pure financial planning, like budgeting or insurance analysis, usually isn't.
Working abroad. Tax implications.
U.S. citizens generally owe U.S. income tax on their worldwide income, even if earned abroad. However, there are foreign earned income exclusions and foreign tax credits to avoid double taxation. Also, the U.S. has totalization agreements with about 27 countries to coordinate Social Security coverage and taxes, so you don't pay into two systems. IRS Publication 593 has details. Many countries also waive their tax if you pay U.S. tax or allow deductions.
Okay. And lastly, the net investment income tax, NIIT, and the Medicare surtax.
Right. The NIIT is an extra 3.8% tax on investment income for higher earners, folks with AGI over $200K single, $250B married filing jointly. As the author noted, there's speculation it might be repealed, so maybe deferring investment income if possible could be wise, but who knows?
And Medicare tax.
There's also about a 0.9% Medicare surtax on earned income above those same thresholds. Not much you can do about that one, as the author joked, other than earn less.
Right. Wow. Okay, that's quite a tour through some advanced strategies. It really shows just how deep tax planning can go.
It really does. That was just scratching the surface, but hopefully highlights some of the most powerful ideas that are still relevant today.
So, wrapping things up, what's the main takeaway message for our listeners from all this?
I think the central theme is that tax management, it's a really powerful tool. It helps you achieve your bigger financial goals, your family's well-being. But it's not the only goal. It's not the destination itself.
Keep the big picture in mind.
Exactly. Look at the whole picture. And remember that diversification we talked about with the tax triangle. Diversifying across tax treatments is a smart hedge against the risk that tax laws will change, because they probably will.
And this complexity really underscores the need for good advice, doesn't it?
Absolutely critical. You really benefit from having a team of fiduciaries, people legally obligated to act in your best interest. That could include a financial planner, a CPA, maybe a tax attorney, real estate attorney, insurance specialist, depending on your needs.
And you made a point earlier about the financial planner having maybe a broader view than just the tax preparer.
Often, yes. A good financial planner looks at how taxes fit into everything else your cash flow needs, your risk tolerance, your estate plan, retirement goals. A CPA might be laser-focused, quite rightly, on minimizing this year's tax bill, but sometimes that might conflict with a longer-term goal. You need both perspectives.
Makes sense.
Yeah.
Is there any comfort in knowing that some parts of the tax code tend to be more stable than others?
I think so. Historically, tax benefits tied to things Congress generally wants to encourage, what the source called benefits for widows, orphans, and retirees, tend to stick around. Think incentives for homeownership, saving for education, retirement security, certain insurance benefits. They're less likely targets for sudden, drastic changes.
That's somewhat reassuring. Okay, so as a final thought for our listeners to chew on, building on what we've discussed.
Yeah, here's something to consider. Our tax system clearly nudges us towards certain investments over others, right? It employs, as the source estimated, maybe 1 million or so great minds just focused on compliance, optimization, finding loopholes, rather than maybe inventing the next big thing or building a business.
So the provocative thought is,
how might those kinds of market distortions driven by the tax code itself impact your own investment decisions? And what does that mean for the economy overall? But more personally, how does understanding that influence the way you approach your own financial planning and building wealth? Something to think about.